we want to conclude this chapter with a few more examples of some multiplier types of valuation models. And then we want to work our way into some discussion about information and how that has an impact on the value of the company. So we have some other multipliers that are available. There's the multiple of sales, price to book value of the equity per share. We also have an enterprise value per subscriber. Again, this is just an example of something that each industry may have its own multiplier that relates specifically to that industry. So for Coors here, we found that the price to sales was published as 2.41. Estimated sales for the company is 4,310, and the number of shares 182.61. This ultimately gives us a value of this stock of $56.88. Again, all of these models, all of these techniques we've talked about have been giving us different kinds of values, different based on different concepts, different things that have influence on market price. Now, the limitations of these multiples, right, is that there's no real guidance about how to adjust for differences, right? What happens if the company changes the risk factors? What if the company changes its accounting policies? All of these will have influence on these multipliers, and there's no real clear guidance on how to adjust for that. So comparables only provide information regarding the value of a firm relative to some other firms in a comparison set, right? Using multiples will not help us determine if an entire industry is overvalued. It only relates to a specific company. So discounted cash flow methods have the advantage that they can incorporate specific information about cost of capital, future growth, and cash flows. So they have the potential of being more accurate than the use of the valuation multiples. Again, what we're searching for in the end, we're trying to find as many ways to look at value as we can, and then try to understand what influences those numbers. Because if you can influence the numbers within the model, you have the opportunity to increase the stock value. There is another technique that's not in your textbook, but I find it kind of appropriate when you're thinking about analyzing company performance. This is what's referred to as the growth opportunity model. So the value of a company can be conceptualized as the sum of the value of a company that pays out 100% of its earnings as dividends, plus the net present value of the growth opportunities of the company. So we have a value as a cash cow, plus the net present value of growth opportunities. Now, how this works with Coors, again, this is part of the stock valuation model, right? The only thing we have to add to the data that we have already input into that particular model is the earnings per share next year that we predict. In this case, it says the stock value is $38.95, and the value of the company as a cash cow is $39.80. If you subtract those numbers, we find out that this company has a negative net present value growth opportunity value. So what does that mean? What that means to me is, based on this stock value, what it means is that the shareholders are not valuing the future opportunities of this company. They are seeing the strategic plan, if you will, of this company as detracting from future value rather than adding to future value. So this could be a picture of what the shareholders actually think about management's strategic plan and the things that they're doing. So, final words on this, no single technique is going to provide us with the best answer. We need to use a combination of these approaches. Some approaches will work better for other companies than not, right? For the basic company, you're going to find a range. So the PE ratio, maybe we say the PE ratio next year is going to be between 4 and 5. So that's what this range here of PE ratio means. The vertical line here in the middle represents the current stock price of this company. So we can kind of predict something here. This is Coors. When I did this, their current price was $43.43, and you can see the dividend model was $43.52, the payout model $54, free cash flow $63, using the PE for the company $43.53. The industry, we know that's a much bigger number. Industry multiplier was still pretty close, $44. The price to sales multiplier about 45. And again, using this net present value growth opportunity, we actually have a negative growth opportunity value here of negative $20. So the shareholders are saying, look, we really don't like the strategic plan of this company, that they haven't been able to show us how it fits into play. So they're thinking that the value will go down over time. So again, we can look at a variety of these models. We didn't discuss the earnings dividend model for this particular class. So now again, we get a range of answers. In this case, they're all pretty much in the ballpark, right? We're essentially saying, look, the stock price is somewhere, where's the lowest number? Between 43.53 is what we predict, somewhere between there and $63. And all of those values are more than the current price. So we're predicting, at least at this point, that Coors is maybe slightly overpriced from what the market is currently telling us. So the information, how does information affect stock prices, right? Stock prices are generally driven by the demand curve. Shareholders buy and sell based on the information that they receive. So there is this, they refer to the valuation triad, right? It's a combination of what does it cost to finance operations? What do we think future cash flows are going to be? Ultimately, how does that influence share value? So we want to talk specifically about information. For a publicly traded firm, its current stock price should already provide very accurate information, right? There are literally thousands and thousands of investors who are analyzing companies. Based on their analysis, the stock price that we see, we have to assume includes all the information that's known by the public, right? So a valuation model will tell us something about the firm's future cash flows or cost of capital, right? If we know the stock price, we can do some algebra and solve backwards for what that's telling us about the future values of the company. The theory that we want to talk about here is something called the efficient markets hypothesis. Essentially, it implies that securities are fairly priced based on their future cash flows, given all the information that's available to investors. And really, that's the key here. How much information is known about a company? If you think about the world, right, the world of information, some of that information you and I have access to as public citizens. But there is private information, right, inside information that we don't know. So that's why we talk about prices are affected by the information that's available to investors, not all information. So public or easily interpretable information if the impact of this information is available to all of us, right, based on, information about future cash flows, we can do this easily, it's not hard to evaluate, then all investors can determine the effect of this information. In this situation, right, we expect the stock price to nearly instantly change when news happens, right? When you get a piece of information, your mind automatically reverts to how will this affect the value of a company. So here we have a company, Myox Labs, right? Because of some side effects that have been leaked to the public, if you will, its future expected cash flows are expected to go down by $85 million a year for the next 10 years, right? They have 50 million shares outstanding, no debt, cost of equity is 8%. If this news came as a complete surprise to investors, what do you think would happen to the stock price? Well, you can think, if bad news happens, what would that do to your appreciation of the stock? Obviously, it would decline. But we can quantify this, right? We know that the value of the company, $85 million is what the decrease is going to be. Cost of capital is 8%. So $570 million is the decrease in value of the company. If you plug this into the stock price, right, the valuation model, $570 divided by the 50, right, with $50, 50 came from 50 million shares, the stock price would roughly fall around $11.40. Because this news is public and its effect on the firm's free cash flow is crystal clear, we would expect the stock price to drop nearly instantly. It's going to fall very quickly. What about private information or information that's difficult to interpret? Private information is held by just a few people, right? That's why it's private, right? They may be able to profit by trading on their information. If they can do that, in this case, obviously the efficient markets hypothesis won't hold in the strict sense, right? As these informed traders begin to trade, though, they're going to tend to move prices so that over time prices will begin to reflect that information as well. So if profit opportunities from having private information are large, right? If there's lots of opportunities, other people are going to devote a lot of resources to try to get this information. But the information is very difficult to get, right? In the long run, we should expect that the degree of inefficiency in the market is limited by the cost of obtaining this information. Since the information's hard to get, it's going to be hard for people to get it and trade on it, right? So if we think about some private information, right? Here's a company, right? If they just announced a new drug, they're seeking approval. If they get approval, future profits, right, are going to increase by $750 million or $15 per share, given its 50 million shares. If the development of this drug was a surprise, and if the average likelihood of the FDA approval is 10%, what would you expect to happen? Well, again, 10% approvals, 10% competition should lead to an immediate jump in the stock price. 10% of the $15 is $1.50, right? However, what's going to happen over time? Analysts and experts are going to look at this much closer now. The information is now public, right? So possible paths of this price's change is kind of dependent on what happens as the future gets here, right? So we end up having there's this announcement, the stock price rises dramatically, but what's going to happen after that? As analysts gather this information, if they're gathering it and they have positive feelings about it, we can see a continuing increase in the stock price. However, if it turns out that there's a decrease in the probability that the FDA is going to approve this, right? If there seems to be like there could be some negative influences on free cash flow, in the end we could see the stock price ultimately decrease after this initial jump. So again, what does this mean for investors, right? If stocks are fairly priced, then investors who buy stocks can expect to receive future cash flows that fairly compensate them for the risk, right? In this case, right, the average investor can invest with confidence, even if he is not fully informed. But what does it mean for corporate managers? Number one, they need to focus on net present value and free cash flow. They need to avoid any of the accounting illusions that are available to them, right? Investors see through accounting changes, and they need to use financial transactions that support the investments of the company. We'll talk about this a lot further when we get to talk about financing. How do you finance the operations of the company? So the efficient markets hypothesis states securities with equivalent risk should have the same expected return. An arbitrage opportunity is a situation, again, we've talked about this before, where we have securities with identical cash flows and risk, but they have different prices. If the market is efficient, we should not be able to find arbitrage opportunities. That's the end of the chapter on stock valuation.